is the agenda for the training. Do you have to call her in or?
Just wait for her to log in. It's recording right now, so.
But I thought she was gonna come on.
She is.
Oh.
Give it a sec.
Okay.
She is. I think I gave her the other, she gave us the WebEx and I've kind of given her a last minute curveball, so we'll see.
Stay.
Gentlemen,
Hello, sir.
how are you?
Good, yo?
Good.
Good, good. We're just waiting for star of the show.
Okay.
How
I'm
are you,
excited.
Doug?
I'm good. How about you?
Excellent, buddy. Absolutely excellent.
You guys both at the office?
Yes, sir.
Okay.
I just had some of Naresh's steak.
What was left of it?
What was left of it? Yeah, it was good.
Nice.
You gonna bring in some fish? How many fish did you keep?
Well, it's a funny thing. My buddy has a fellow up there. They call him a white First Nations guy. He's got some percentage of First Nations in him, so they can keep whatever they want.
Really?
Oh yeah, they just assign it all to him.
Nice.
So, because as a First Nations individual, you can hunt, fish. There's no seasons. There's no limits. There's nothing.
Where did you go and what did you fish for?
I went to a place called Mojapong, which is like 4 hours north of Espanola, which is an hour from Sudbury.
Okay.
Wow.
We fished
You were
for,
up there.
oh yeah, we were up there. Lake trout, pike, pickerel. We didn't get any pickerel, and there's no bass in this place. It's just lake trout and pike. The guy on the weekend, the guy caught a 20-foot. Yeah, it's got big fish. I mean, they were showing me pictures. I mean, there was a guy on, I think on Saturday, in the rain, caught a 25-pound pike.
Wow.
Oh.
Hi, it's Emma on the line.
Hey, Emma. How are you?
Hi, I'm good. How are you, gentlemen?
Good.
Excellent.
Good. We actually got Doug, surprise visitor. He was able to pull it off. He's just driving back from up north. He had a last-minute fishing trip.
Oh, good. Are you allowed to fish already? I thought they were like spawning. That's what I tell my son. I was like, oh, the fish are having little babies right now, so they can't fish.
Well, that's true, but season opened on pickerel and lake trout,
Okay.
pike, I think, 2 weeks ago.
Oh, good, good.
Yeah.
So, so if we can just do a round table to see who's on the line. My name's Emma Scott. I'm calling from EDC's broker channel. Who else do we have on the line?
Doug Dombrowski, Affinity.
Naresh Via from Affinity.
And Don Miller. From
Okay.
Parts Unknown.
From Parts Unknown. So I would like to get Doug and Naresh's last names and contact info. I have some emails, but I don't know if they are Affinity insurance emails. So love to have your phone number and your contact information so that we can actually, EDC could share some, get your castle consent and share information with you. So I'll send some follow-up emails afterwards so that we can gather that information to make sure that it's accurate. We spoke with Naresh. Your insurance and is done. Happy to take questions as we go forward and happy to have follow-up afterwards. And interested to hear a little bit about sort of next steps for Affinity after the fact, if this is something that how Affinity is advancing their presence in the trade credit space at this point in time. Basically, the way that we normally go into these is sometimes we do them in person and sometimes we do them remotely. EDC's broker channel has been formalized as a indirect sales force within EDC. We sit under a VP where we collaborate with a bank channel, a strategic partners alliance, and then the broker channel. And we are essentially EDC's indirect sales force. So we work with external parties to promote our corporation and part of the Export Development Act that was established in 1944, and we are here to promote international trade with Canadian companies. We have a variety of different products in order to do that, and we provide advisory services to Canadian companies on new markets, on sort of their journey to export, and we also provide financial products through our standard product offering of trade. One of the external parties that EDC also participates in is called Receivables Insurance Association Canada, which is a forum that is made up of both brokers and insurance carriers. EDC is the board, as are different specialty brokerages that are across Canada. They do operate a website called, I think it's been rebranded as Trade Securely, and the different carriers and brokers will produce information and post on there. They are active on LinkedIn, and there's corporate videos from the different brokers and carriers that we sort of facilitate and promote through that. And I encourage Affinity to source whatever information they need and connect with REAC if they are interested.
So can I just interrupt you for a sec, Emma?
Sure.
So yeah, so what are you on a specific slide number? Just I got a little sidetracked.
I'm on slide number 2.
Okay. Okay. And what was the name of the association again?
It's called Receivables Insurance Association Canada. REAC is the acronym.
REAC. Okay. Now, is there another one as well? Because I was on there like earlier this week. And remember, I sent it to you, Naresh, and I went through all the members, and there wasn't one insurance partner. It was all like bankruptcy and collections people and all that stuff. Do you know that one?
Is it an association? I don't know that one. This REAC is made up of insurance carriers and broker partners.
Okay, I'll send it over to you. You can kind
Sure.
of just offline. I don't want to hijack your presentation, but I found that very interesting. So I'm glad that you brought this one up. That's very helpful. Thank you.
Okay. The advent of it really is to promote the product of trade credit because it's not a product that a lot of people are aware of. And so it was really born and to increase the visibility of the product and the benefit within the Canadian market. So that is the purpose of REAC. And so happy to share some information and the link to it. So I'm going down to the third slide and really what credit insurance is. And so like in any contract, there is the insurance company is the provider of the policy. And there is a Canadian company which is referred to as the exporter here. But there is a third party who is the buyer. So it's the foreign buyer that we look at. So the policy is held between the Canadian company or the exporter and EDC. The beneficiary of the policy is the Canadian exporter. And what EDC does is we actually look at the credit worthiness of the foreign buyer to assess. So Canadian company A, B, and C, you want to sell mugs to this company in Ghana, and they're requesting a contract for $300,000. We'll go and assess the credit worthiness of the Ghana company to sort of say, are they credit worthy enough for $300,000? If you have continuous shipments over this year, we'd be happy to provide a credit approval for $300,000. So the credit insurance policy actually protects the owner, who is the Canadian company, against the risk of non-payment by the foreign buyer. Are there any questions sort of on the contractual relationship there? I'm on slide 3.
So Emma, thanks for asking. My IT person here just tapped me on the shoulder and he's showing me the screen. So I guess, would it be possible for you to, if I share my screen with you, that you could pull up the presentation on your screen so we could actually see it as you talk? How do you do that, Nathan?
Yeah, so yeah, I was looking to sort of I have been made the presenter. Is that what I do? I share my screen?
Yes. Nathan, you can speak.
Okay.
Sorry, my IT person's he's a little strong. One of those IT guys is all greasy and he's in like a little corner.
Okay, so it's Nathan. I just share my screen here.
Yes.
Okay, let me know if you guys can see it.
He's actually my first cousin. So.
Oh, yes.
Oh, that's better.
There we go.
Oh my goodness. Now we're in business. Thank you
Okay.
so
Now we can put all these scraps of paper away.
Excellent.
Okay, perfect. Go ahead.
So do you want me to sort of go over the diagram again?
No, I'm good. How about you?
Okay.
Or do we have it recorded, Nathan?
It's recording.
Oh, it's recorded. Okay, yeah, no, we're fine.
But only
Okay.
now it's green.
Right, but it's still, no, we're fine, we're fine.
So really credit insurance, the essence of it is that it protects the Canadian company or the purchaser of the policy against the risk of non-payment. That is, in its simplest form, it's what it does. So when you have foreign buyers that you insure underneath your policy, the Canadian company is protected against the risk of non-payment. And then we'll get into the additional risks that there are, but the largest umbrella of it is basically non-payment. So they can then file a claim underneath and receive indemnity, which is the claim payment from EDC. I'm going on to slide 4. So I'm just going to hide part. Sorry, Don, you asked me a question?
What's your loss ratio?
Off the top of my head, I don't know what it is, but it has been posted on our annual report for 2017. So I don't know what the ratio is, but I have the loss numbers, and they are rolled in with the entire insurance group, I believe. So I can come back to you on that.
Okay. Not a big
Okay.
deal. I was just curious. That's not a problem.
Okay. So basically the benefit of having credit insurance is that it's a risk management. So it essentially protects the Canadian company in the event of non-payment. So it's having the risk expertise where we look at the foreign buyers that you are looking into doing business with and entering into a contract. And because they're not your next door neighbor, they're in another country. So sourcing the repayment of funds from a foreign entity becomes more challenging. So it really is a risk management framework. And the reality is that accounts receivables is the second largest asset that's on the balance sheets for most Canadian companies. So why wouldn't we want to protect them? And that's essentially what it does. Is it's the accounts receivable, or the AR, that becomes it's a protection in the event that they're not paid from your clients. The benefit of also is that it increases companies that are exporting. We are well aware that they will grow exponentially because they're having increased sales volumes, where they're not just selling within their regional base, they're actually going outside of their regional base, and whether it be within your city or your province or your country, and you're going out to find new buyers for your goods and services. You can go to business with new markets, but knowing that you're protected from a risk management perspective because you're purchasing insurance in the event that that new buyer does not pay. It gives you comfort when you're entering to a new country market. And you can actually then go into a country market and actually offer open terms. So often what we've found is that companies that start doing business outside of Canada will only do it on closed terms, like CAD terms, cash upon delivery, or cash against documents. But what this does is having, net 30 to net 90 to what are at 180 day terms, it offers more flexibility for your foreign buyers when purchasing goods from you. And the third benefit that we have to offer is that you can actually get an increasing working capital and improve with liquidity from your bank. Banks will actually increase the working capital if they know that you actually have the receivables are actually insured. So banks do like the product, and they will offer additional financing in that vein. The other point is that they can become an assignee under the policy. So in the event that there is a claim payment, it can be directed directly to the financial institution, so that the funds for the claim wouldn't go to the company that owns the policy, it would go straight to their bank. So that's a greater comfort level for the bank as well, that they're covered, and in the event that there is a problem, they would be the payee under the policy. Any questions at this point in time? No.
One question, Emma. You mentioned goods and services. What kind of services would be covered under this in terms of export?
We have currently we've updated our standard types of coverages. So we have an export receivables policy, and then we have an export receivables and costs policy, which, depending on the type of service and the timeline when a service is actually the costs incurred of a service. So some services, the upfront costs are borne by the Canadian company, and so depending on if it can be customized or when that cost incurred is taking place, we do have costs covered. So in the event that a contract does become cancelled, the Canadian company can receive coverage for the costs that they have incurred up to the point of cancellation. So we do find that there's some telecom and services that are have services, or even like logistics services. So trucking companies that are booking, logistics for trucking, they are one of the services that we do offer coverage for.
Okay, yeah, thanks, understood.
Okay, I'm heading to slide number 5. So types of coverage. If you're client is shipping merchandise or providing services, the coverage starts at the date that the goods are shipped or at the time that the service is rendered. And then this just goes back to what we were talking about. And if your client wants to cover work in progress, so coverage begins as soon as the time that costs begin to be incurred under the contract. The manner and how they're declaring their sales or their contracts are a little bit different from these two different types of coverage, but they do the secondary point for work in progress. There is a price differentiation, but they are covered for the costs incurred at the outset of the contract being signed. And it's really for, manufactured, customized goods with longer lead times. So if somebody was fabricating, a custom type of, piping or something that could not be resold easily, they would be, they maybe benefit from a costs incurred type of coverage. Does that help answer your question?
Yeah, no, that's fine. That's perfect. Thanks.
Okay. We have updated our policy in the last year, and so we went from risks insured to calling them insured events. So the standard insured events really are the payment default, so the risk of non-payment when the buyer is unable to pay or unwilling to pay. The third is bankruptcy or insolvency, when the buyer has gone bankrupt. And then the third is called repudiation, but a lot of people don't know what that is, so we've kind of simplified it. And it's really when the goods are placed at the buyer's disposal, but they refuse to take delivery. And this happens often with commodities. So goods have been placed in transit, and sometimes they take time to be delivered. So if they're in a container and on the water, it may take sometimes, 2 weeks to 30 days for a delivery to happen, say perhaps in, Middle East or Asia or whatnot. And if there is a commodity price drop, let's say it's chicken that's on the water and all of a sudden the price drops in a particular market, a buyer may choose not to then accept the goods at that juncture because they're not going to be able to sell them at that same price that they purchased them for, but they're not going to take possession of them and then have to pay for them. So they will simply refuse to accept them. So that is a coverage that is offered by EDC. There is a process where we do work with the client to ensure that the goods are attempted to be resold or destroyed, and then we will go through the claim process. But it's called repudiation coverage. Not all carriers offer that as a standard type of coverage, but these insured events are part of our standard coverage offering. Termination of contract is the date the contract is canceled by the purchaser. It's under our costs, receivables and costs policy. And then there are some political risks that are covered under the policy as well, such as war, currency and conversion, transfer, and import and export permits. So in the event that you are, exporting goods outside of Canada, and from the time that the contract or the purchase order is made to the time that you're sending the goods out and across the border, an export permit is revoked or an import permit into the other country is revoked, that is a typical political risk coverage that is covered under a policy. Those types of risks do not happen every day, and so we are aware, when those are happening, whether those trade barriers are happening. So we'll know that, let's say something happens in perhaps the Middle East, we'll have information that's available to EDC and basically to the public that there is a trade barrier that's happened within that particular market. One thing to mention is that all types of insurance have a co-insurance. So EDC's standard co-insurance is a 90-10, which is where covered 90% of EDC coverage, and the 10% remains with the Canadian company. So if your client had a loss of $100,000 and went to file a claim with EDC and had full coverage, the claim payment would be $90,000. I know you guys are all insurance guys and you have background in surety, so just wanted to check in. Is that clear with you?
Yeah, that's fine.
Because I know surety works a little bit differently, but that is sort of a standard co-insurance for EDC. We'll go through the exclusions, so coverage exclusions, what is excluded under the policy. So EDC has requirements of duties of the insurer, that coverage exclusions, sorry, and in the event that you have a buyer that has not been paying you for more than 60 days for an existing account, and you as the Canadian company continue to ship, that is a coverage exclusion, because we're asking that you actually report that as an overdue if your buyer is not paying you within 60 days. Documentary risk, we do not take on documentation risk, whether that be something as part of the Canadian exporter, they had to have their documents in order to cross the border. That's not a risk we take on. Misrepresentation is also not a risk. And then changes to the payment terms without EDC's consent. So if you have a purchase order from a Canadian company that your standard purchase orders might say, net 30 days or net 60 days, but your policy, let's try a different example. Say it's standard up to 90 days, and then your client wants something that's over and above that, say at 120 days. If you haven't called EDC to sort of advise us of that change, that would be a coverage exclusion. And EDC works with our companies. We want to be flexible, and we know that things do change, but we do need to be aware of these changes as they happen. So we ask for open lines of communication and for EDC to be aware and advised of when these changes take place, so that we can ensure that the insurance that's in place reflects the type of sales that are to be covered by the Canadian company. Sales that are to a related buyer. So if a Canadian company has a sister company in Canada and they're looking to insure sales within those companies, we actually ask that they are two separate legal entities and that they are not related. So we will not, part of our standard offering is that we will not cover sales to any related buyers. The corruption of foreign agents and failure to obtain licenses and permits are not covered. And then we also have anything that would be a cause avoidable by the Canadian company or by the insured. So if there was within a reasonable coverage, if there is something that the client knew about and was able to avoid, so if they knew that there was a trade barrier coming, and they'd heard about it through their association and they continued to ship regardless, that may be construed as a cause avoidable by the client. Any questions on the coverage exclusions?
Yeah, just a quick question on misrepresentation. Is this misrepresentation on the buyer's part or on the seller's part? Because a buyer could misrepresent. It
would be on the seller. On the seller.
All right, that's fine. Because you may not know, even after doing due diligence, you may not know 100% that the buyer's actually misrepresented you unless it's too late.
Right, and it's within a good faith that if it's outside of your control, and there is sort of an assessment that's been done from a claims perspective, and I spent quite a bit of time in claims, that we will sort of look at the situation, and we are in touch with the buyers, and if they're responsive, we will sort of have a dialogue with them to see, is there a repayment plan, what took place, and why is the event of non-payment happening. If sometimes it is simply a bankruptcy, and if that is the case, that's the case, but we will do some assessment, and we do work with buyers. When EDC pays claims, we also do make active recovery efforts to recoup on our losses, and we will continue with repayment plans with the foreign buyers, and we work with legal counsel and collection agencies. So there is information that's ongoing even after the claim payment that happens with the recovery efforts with our EDC's team. Any questions?
No, that's good.
Okay. Obligations of the insured on slide 8. So we look to the Canadian company to provide, the volume that they're looking to report and the premium payment. So they may have a company that says they have $10 million in sales, annual sales. However, they may only choose to insure 5 million of that insurable volume. So they're going to come to us and say, okay, my company is worth 10 million, but I'm only looking for coverage perhaps for sales to Mexico and the US, and I'm not going to insure my sales in Canada because I'm comfortable taking on that risk. So we'll only insure the sales volume of whatever is requested, and then we would ask that the client pay the premium for that amount. We do look that the client will report any outstandings that are $100,000 that are outstanding for greater than 90 days. And we also look that they will establish a credit limit. And a credit limit is sort of it's a credit check that EDC has done for each buyer. And that's where our information on the financials comes in with all of the foreign buyers. So we have a very large database, and it grows all the time in collaboration with our foreign parties. And we're looking at buyers, and we're monitoring the credit assessment and capacity that we already have on the books with these buyers. And it's fed into with our claim system saying, oh, we have had a claim filed against this buyer. We're looking to recover money, so maybe we pause on a limit or we remove all other credit limits. But that is where sort of EDC that does that credit check on those foreign buyers. We also look to the Canadian company to work with EDC and to prevent and minimize any loss. So essentially in the insurance industry, it's looked to as saying, as a standard action of a company, you've acted as though you may not even have insurance. You act as though you're not insured, and you make all efforts to prevent and minimize the loss. So that would be, when you know that your account is already overdue by 90 days, you stop shipping and you sort of work that overdue amount down. And if you're aware of something happening with the company, whether you hear from an industry association or whatnot, you would be aware and you would come to EDC and advise us of, preventing and minimizing that loss. So if you hear something in that your shipment is on the water and either your client has gone bankrupt immediately or is maybe having payment issues, you would call EDC and see if you are going to be, if the client is bankrupt, do you have to still continue with that shipment with them, or can you divert the shipment again? The way that EDC establishes buyer credit limits, we work in a couple of different ways. So the standard policy that we have is that there is something that's called a discretionary limit, which is a threshold of credit, which is standard at about $50,000, and they have different manners in which they can manage the credit up to an amount of $50,000 for their smaller, quote unquote, smaller buyers without having to come to EDC. So there's different ways that they can do that. They can do it through bank reports. They can do it through past payment experience that they have that would be a positive past payment experience. They can also do it with trade references, written trade references, and financials that they may have. So they would look at the financials and say, we're comfortable going up to a credit value of $50,000. That being said, those are not approved by EDC. Those can be that $50,000 credit threshold, discretionary limit, is managed by the Canadian company's own credit department. So we would expect that they would have documentation to support, the onward selling of goods to that company. And in the event of the claim, they would be able to produce, documentation to say, yes, we had financials in this company, or we had trade references, or here's the bank report that we had. And anything over and above the $50,000 come to EDC. So if they had something, a bunch of buyers under $50,000, so $10,000, $20,000 for different buyers, they can manage those limits themselves. And anything over the $50K, they would come to EDC and say, I'm requesting a credit limit under buyer ABC out of the US. And they can do all this stuff online. And so all the policy is now online, and they can simply go in and enter the information and select we look to the client to have the correct legal name of the company, an address, and a telephone number, and input that. And we have through our existing database, we have a vast amount of data, so that often they can pick and choose the buyer that's already there, or they may have to add a new buyer. Any questions on that process?
No.
Okay, so here is a timeline and loss mitigation for our claims, and it sort of just gives you a visual of what is required under the policy. So from the 0 days, which is the due date, if the client hasn't been paid by the due date, we look at the 0 to 60 days that the client themselves would be calling and following up with the buyer to say, are you going to be paying me? What efforts you might be doing. And then from 60 to 75 days, there's no additional shipments that would be made unless it's authorized by EDC. And they can send a demand letter or a payment agreement with EDC from having EDC's sending a payment letter. From the 75 to the 120 days, there's a milestone of 90 days there where all the overdues have to be reported to that are greater than or equal to 100,000 have to be reported through our debt management system. So this can all be done online, and they simply select the buyer and tell us, oh, I haven't been paid. And anything that's up to $100,000 is placed into collection. And EDC, through the reporting through our debt management system, you can actually report the debt and have a collection agency commence working on it right there. I am going to move this. Can you see this Go meeting on my screen as well?
No.
You don't? No, okay. I see it. It's sort of in the middle of the slide. From 128 days from the due date, you can make a claim at that time and file the claim. And from 120 days after the due date, you're actually eligible for a claim payment. In the event that the insured event is non-payment, from the due date, if the insured event is insolvency or bankruptcy, the claim is actually eligible right away, because we know that their buyer's not going to be paying, they are bankrupt. So they are eligible for a claim submission. Now, from the due date, the Canadian company actually has up to a 12-month period to file a claim. Our suggestion is always to file the claim and have ongoing loss mitigation efforts through collection agencies and whatnot prior to that, but they are actually eligible for a claim submission at the 4-month mark, which is 120 days. Any questions on that process? Claims are filed online now, so through our new system that we have, it's a digital platform, and all supporting documentation, so purchase orders, invoices, and bills of lading and proof of debt can all be submitted online, and you can actually see in the stages where your claim is going forward with a debt management officer at EDC, and you can actually see where your claim is at. There is I'm going to see if I can, okay. There's a claim scenario here on slide 11. It's where a Canadian company has come to EDC with a policy and has a foreign buyer, and they've requested a $100,000 credit limit on the buyer. The Canadian company then ships $400,000 worth of goods. So in our view, they've overshipped by 300K. And they also, in this scenario, they also have a bank under their policy, which is an assigned payee, because they've margined a loan against the $400,000 receivable. This is not a great scenario, and the buyer defaults on the payment, so they haven't been paid. So what ends up happening is that the insured company files a claim with EDC, and we look at the eligible loss. So their loss is a $400,000 loss. However, they only had $100,000 credit limit. So the eligible claim payment to the bank, because they are a payee under the policy, is only $90,000 because it's 90% of the credit limit. The loss is therefore felt by the Canadian company of $310K, and EDC and the bank have, EDC is paid out for $90,000. What happens in all instances of claims is that EDC, we do ongoing recoveries, and so we will take what's called a subrogation of the debt, and the title of the debt then transfers to EDC. Even if we've only paid out the $90,000, we will take on the title of the full $400,000 of debt, because in the past what we found was it wasn't worthwhile for EDC just to go after their smaller portion and the client, and to be working in tandem with the client for their portion. It's much the return on investment to go after the full amount of the debt and recover the amounts for EDC and the client at the same time. In the event that EDC recovers $100,000, $100,000 will be paid back to the insured or the bank. If we only make a portion of the recovery, so $15,000, $15K will be paid back to the insured in the bank. And if we cover the full amount of the debt, the $400,000, $310 will be given back to the insured, and $80,000 will be coming back to EDC. This is after recovery costs are taken off of the top, so it's shared in the same proportion of the loss. Any questions on the claims process or the recoveries process? Okay. This is an example of our new policy. So this is the export. The new policy is called the Portfolio Credit Insurance Policy, and it's formed of two certificates. One is the coverage certificate, and then the general terms and conditions. I believe that I've sent you the new general terms and conditions.
Don't believe so.
Okay, that's a follow-up for me. So coverage certificate and the GT&C. So this is receivables and costs policy. We will do that. And that sort of spells out the insurance certificates. They do form two documents, and the coverage certificate, in the event that there's any changes, so we no longer have endorsements to the policy. With our new digital system, when there is a change to the policy, it immediately digitally updates the new coverage certificate. So if there is a deductible on the policy, or there's a new country market that's added to the policy, the coverage certificate itself, which can be several pages long, will be automatically updated, but it forms a new certificate rather than having multiple endorsements under an existing policy. Any questions on that? Okay. We have been through the benefits of the policy already, so I think that this is an actual duplicate of the slide. It really is a risk management tool for Canadian companies to sort of, offset the risk of going into a foreign country to buyers that they do not know as well, and they are, because of the distance where they are located, there is a lower chance or likelihood of being repaid. So this is an insurance to give them a risk management comfort in advancing and exploring into new markets. The banks also really like this type of coverage because a customer can increase their working capital if they have the trade credit insurance. And it gives the financial institution greater comfort because they can be added as a payee under the policy. So the claim payment can go directly to the Canadian bank. Any questions on those benefits of the accounts receivables insurance? So here in slide number 15 is one of some tips that EDC has in how to identify, clients that might be an opportunity for trade credit insurance and might be interested in, learning a little bit more about it. So one of them is taking a look at companies' financial statements, which you guys would have because you have a surety book of business. So you can see if the receivables are actually within Canada or if there are, foreign receivables that are on that book within the financial statements. There should be a line item whether or not the receivables are insured, and you can actually look and see if the receivables have, sometimes there's a high concentration with a few number of buyers, which can, signal saying, well, if there was a bankruptcy with one of these or one or two of these buyers, that is, 75% of your accounts receivable. So that could be a potential risk if there's a high concentration of the receivables just within one or two buyers. So that's one way to identify it. If your clients do not currently export, you can ask some questions about what is sort of some of the challenges that or why do they not currently export? Is it a lack of awareness of foreign buyers? Is it a discomfort of, getting into a new market? EDC can help with a lot of that through our offering with sales advisory services, and it's something new that EDC has launched in the last 18 months, which is trade advisory services to Canadian companies, as we understand that different companies will be at different stages in their export journey. And so if we can demystify information about a particular country, a particular market, or have them be a little bit more aware about, a trade association or a conference that might be coming up. We are doing more matchmaking. We do now have 20 offices around the world. And so our local sales representatives will actually get to know a local foreign market really well. And what we do is we say, we have Canadian companies, we can help you do matchmaking with these Canadian companies if you are interested in doing business with them. And EDC has a program where we actually do gating for supply chains of foreign companies through our global trade group. If your client already has export receivables, does their bank require, are they margining against them? If they do, if the receivables are insured, they can actually probably get a greater margin on the financing that's offered against them, up to about 85%, I believe it is, if the receivables are margined. With the financials, you can also take a look at the claims history and saying, are you aware of trade credit insurance? You did have this loss. How has it affected the growth of the company? Because if there has been loss experience, and what was the loss? How did it impact their cash flow on a going forward basis? And it's companies that really have. A lot of companies say, oh, we don't need it, we don't have any losses. And it's interesting to have those discussions with companies because a lot of people didn't really actually see some of the bankruptcies that were happening. And looking at bankruptcy information is a key way to find prospects. So looking through the creditors in Canadian bankruptcies that happen, you can see the actual clients that have been impacted by the bankruptcy. Not a lot of people saw the Target bankruptcy coming, and that was a lesson learned in the Canadian retail industry at the time, and there weren't a lot of signs of that one happening. The one for Toys R Us was different, but there are recent experiences, particularly within the retail industry, that we have seen in the last year or so that have shown that, you know, trade credit can be helpful and protect your bottom line. Gentlemen, we are at the end of this presentation, so in the event that you do have future submissions or want to hear more about it, you can send an email to brokers@edc.ca. And what I can do today is, Don and I have worked on in the past some surety deals, but we have talked a little bit about trade credit insurance, and today was an opportunity to have that dialogue advanced on, you know, more in-depth discussion on trade credit. I have a takeaway here for to send you the specimens of our standard policies, the receivables policy and the receivables and costs from the general terms and conditions and our coverage certificate. And I can also include our standard application form for a trade credit policy.
Great.
Okay. I was just going to ask, it's probably a bit early for getting an idea of what percentage premiums we'd be looking at, or I guess it depends on the risks and the jurisdictions and countries, right?
It does, you're right. And it also depends on the insurable volume that a client would be looking to insure with EDC. So typically the rule of thumb is the greater volume, the premium drops to a certain extent. So premium values for a client that's insuring $2 million versus 20 million is different, and it also depends on the risk portfolio from the countries that they would be selling into.
Okay.
I can give you a couple of pricing examples. I do have a pamphlet that I can give you that does give a seafood example, and I can give you another one for a retail cupboard company that does give a pricing example as well.
Okay, that would be useful.
Okay, I will send that along as well.
Is there a rule of thumb like 1 to 3% or something like that?
It really depends on the risk portfolio of the countries that they want to insure, and it is factored, as I mentioned, the type of coverage that they're looking for. So the standard coverage is the receivables, and then it is generally more expensive for the receivables and costs coverage because we're insuring the costs incurred at the outset of a contract and the risk if the contract is being canceled midway through. So there is a pricing differential there. There are standard things that we can look at. So deductibles is one of them. So a company's appetite for a deductible will impact the pricing. If they're looking to have a larger deductible, it will bring down the pricing. The other thing is if they want to have a company that has $10 million in sales, but only wants to insure only their sales to Mexico. May only have an insurable volume of 2 million, but if they wanted to insure a whole turnover, so all of their sales within Canada and their US and Mexico, that would bring the pricing down because there's going to be a higher volume of sales. The other thing I'd like to mention is that EDC is the Export Development Canada. We're mandated by the Canadian government for export sales. So we do it for receivables that are outside of Canada. We do have a joint policy with COFAS Canada. It's been a 10+ year partnership with COFAS. So if you have a client that has sales that they wish to insure in Canada and for export, we can offer that type of coverage. It's done through a joint policy that we have with COFAS. But it is administered at EDC, so the premium is paid once to EDC, the claims handling is managed by EDC, and on the back end, EDC and COFAS have a partnership to split that premium and the claims and whatnot. So it makes it easy for one-stop shopping for the client.
You're saying about 1 to 3%?
Sorry, go ahead.
Were you saying about 1 to 3% then? Is that the range, or 1 to 5, or?
I'll come back to you with the pricing range,
Okay.
but it's based on it's a percentage basis.
Okay. What's the minimum premium?
The minimum premium is 750 Canadian dollars.
Okay. And what
So
is
EDC
it?
in
Go ahead.
US it's 550. It's $550 US. So EDC, we do the very large strategic stuff, but we are also, because we're mandated by the government of Canada, we also specialize in the small business as well.
Right. And you were going to show us maybe, was there a way for us to facilitate the smaller stuff via a portal or something like that?
So everything is actually operates now through a portal. So the new policy that we launched, portfolio credit insurance policy, we launched last September nationally, and it essentially it's a digital portal. Everything is online. So if there is a credit limit that your client needs to be added, the claims, the credit. The billing is all online. So it doesn't operate in the same, well, it operates certain in a same venue as, I know some of the property casualty not brokers, but carriers do have their own separate portals. So essentially the portal is the system. And a lot of it is self-serve so that you can see our credit, our claims, and our policy administration is all in the one portal now.
Okay.
Yeah, we do not also have a volume minimums or quotas that is required by our partners. We do want to see them, how we can help them grow their business. Don, you shared with me that you're sort of looking in the SME section for Canadian companies. Is that correct?
Sorry, I don't understand your question.
The segment of business that you'd be targeting for credit insurance.
Oh, I don't know. I think we'll see. We'll see. It's I would think so. That'd probably be the lion's share. Yeah, I would think so. Yeah.
Okay. So the minimum premium is important. The other part I would like to share is that there is an completely online product that is sold to clients directly. It is called Trade Protect, and it does not pay broker commission, but it doesn't have, it only goes up to a threshold of $500,000. So anything over and above that would go to be bumped over to a portfolio credit insurance. And it does have certain limitations on it. So certain countries wouldn't be insured based on their risk portfolio. And there's a limitation of certain products that aren't covered under that portfolio. But it is sort of for clients that really only have one-time sales. So if they're only selling it to this buyer and there will not be any further repeat sales, it's really geared to that micro exporter that's sort of saying, okay, I only have one sale to this guy in Kansas or whatnot. So that is called Trade Protect. It does not currently pay broker commission, but it's really for the micro exporter.
And what is broker commission?
Broker commission is, I can send you the link to our broker terms and conditions. It was updated in 2017. Standard market rate is 15% across the board for anything that had been insured previously. For clients that have not had credit insurance in the last 6 months, it's 15% plus a 5% bonus for year one.
And so just to clarify, so you would actually, so a Canadian company called me up and was sending, I don't know, a shipment of, I don't know, whatever to say, I don't know, somewhere in Africa that you guys had approved. And it was and they wanted that insured. You guys would actually insure a one-off creditor in a foreign country.
Yeah, so as long as we can get, comfort on the buyer, so the country and the buyer, we do offer up to a $500K policy that's in place for a period of 180 days.
Okay.
Yeah. I can send you a little video on that policy or then product. It currently does not pay the broker commission because it's really geared to the smaller segment of business that really is sort of looking to kind of dip their toe into selling to foreign entities, and it's completely 100%. There's no human really touching it. It's all system driven.
Right.
Was this helpful today? Was this
Yeah. Yes.
time well spent for you?
Absolutely. And last question, so you guys have minimum premiums, but there's no minimum amount of AR that you would insure. I mean, say someone came to you with something really small, like, I don't know, $100,000. You'd say, well, we'll do it, but it's $750. That's your minimum premium.
Yeah, and like we kind of look and say, is it worth, are you going to be selling to this company? Like, are you going to have $100,000 worth of sales continuously throughout the next 12 months? And we really base it on the 12-month period of coverage, saying within the next 12 months, are you only selling $100,000 to this one buyer? And if that was the case, it may be better placed under that trade protect. Now, if they were going to be selling again and again $100,000 to this foreign buyer throughout the year, and the total volume might be 1.2 million, or let's say it's $700,000 over the next 12 months, then it would be better placed under a portfolio credit insurance policy.
Right. Okay.
Yeah, so it kind of, go ahead.
No, you finish what you're saying. I'll come back. It's a separate issue.
It really depends as to whether or not there's continuous sales to that foreign buyer, but the minimum premium is Canadian $750.
Right. Okay.
My question was regarding COFAS.
Yes.
The policy wording and terms would be pretty well the same as you're adminning it, so it would mirror your policies, I guess.
Yeah, Naresh, this is a great question because right now we are actually running two different policies. And so the policy that we have jointly with COFAS is still under our old policy wording. I would be happy to send you a copy of the old policy wording. It's the standard policy is called a shipments policy. I can send you that one, and a contracts policy. And then under our new portfolio credit insurance, it is only for export receivables only. So when we do have new submissions come in, we will be very prescriptive in asking you, saying, do they wish to have Canada insured under this portfolio? And if the answer is no, it will be launched under our new policy and the new digital framework. We are in the middle of a project called with our new platform to sort of onboard the domestic piece, and we're looking at out of the box solutions on that, but it's simply not ready at this time. So we have been converting our policies for our existing policies that were export only onto our new platform. But currently, if you have a client that wants to insure their receivables for export and for Canada, they'll be under our former joint policy with COFAS and our old sort of framework. And I really want to make that clear, is that EDC can only quote on something if there is an export receivable. So if there is a foreign buyer involved, if there's only sales inside Canada and no export, because of the mandate, we're not able to quote on that business. There needs to be an export component.
Okay, that's good. Thank you.
Okay.
Great, Emma. Well, thanks so much for your time, and we look forward to your follow-up. And so we look forward to getting that first submission in so you can give us portal access and all that other good stuff.
That's great. Thanks very much, gentlemen. I hope you have a good day.
Thank you so
You
much.
as well.
Take care. Bye-bye.
Bye.
Bye.